Hi all, this is lesson on section 3.3, the balance of payments. This is how governments manage and classify all the money that is both sent overseas and received from overseas. Some countries do this slightly differently, but to counter this, what the IB have decided is a common version that they expect us all to know and use for this course. We'll go through each of these items in a bit of detail, but it'll be worth it for you to get these notes down as a bit of a concise summary. We do call this the balance of payments, or the BOP. That means there must be some balance in here. What happens is that the current account equals the financial account plus the capital account plus errors and omissions, and that equals 0. We'll get back to this a little later. Okay, let's go through these. The balance of trade in goods. This is what first comes to mind when we think of imports and exports, the goods. When we note these figures, the imports, like iPhones into Australia, are noted as a debit, a negative number in the current account. This is because the money is leaving the country to pay for the iPhones. Exports, like the iron ore that we send from Australia, go in as a credit, a positive number, because the money comes into Australia. Trade and services. An import of services occurs generally when we pay for services overseas. A common example is tourism. So when I paid to see this beautiful mosque/cathedral in Cordoba, Spain, it got entered as a debit or a negative in the current account because the money left Australia for overseas. Our biggest export by far is education. And if Sean's watching this, Glenunga International High School does take international students. When these students pay for high school, and many more do university, when they pay for that, it counts as an export and as a credit in the current account. Another way that money moves in the current account is income. Let's say Apple make profits here in Australia. They're going to send that money back to their shareholders, most of whom would be based in the US. The money leaves Australia, so it's a debit in the current account. On the other side, if I own shares in foreign companies like Tesla or Facebook, I will receive a share of the profits. So that money is going to come into Australia and be a credit in the current account. Sometimes money given to people by governments happens to cross borders. For example, an Australian, like my brother-in-law, might go to Spain for a year to study in Granada. He was eligible for AusStudy, which are the payments that the government make to certain full-time students. And so he was eligible for that while he was overseas. So when that money left Australia, it was counted as a debit in the current account because it was leaving Australia. Transfer payments also come into Australia. So a common example is British people living here but receiving a pension from the UK. So that's their retirement benefits paid by the government. That appears as a credit in Australia's current account. A very common paper 2 question is to identify components of the current account. The 4 headings we have here: balance of trading goods, balance of trading services, income, and current transfers is what they'll be looking for. What I find is that a lot of people remember the balance payments, the current account is about imports and exports. And that's all they'll say. And you really need to show some knowledge of income and current transfers. Okay. Just so we know our debits and credits, I want you to have a look at the current account data here and determine whether there is a current account surplus, a current account deficit, and how big the surplus or deficit is. Okay. This is relatively straightforward. 85 export of goods is a credit, so positive, minus 48 because imports of goods are a debit, plus 79 for export of services, minus 82 for the imports, plus 56 for the income coming into Balmastein, minus 88 for the income going out, plus 5 for the transfers going in, minus 6 for those going out. Altogether, that leaves us with a current account surplus of $1 million. Next, we'll look at the capital account. This is the smallest of the three. We have capital transfers, which is when capital is just given. It's just given between countries. The most common form is debt forgiveness, where the government may just cancel some of the debt that is owed by other countries. Otherwise, there are investment grants where the government gives money to fund physical capital. Within the capital account, there are also non-produced, non-financial assets. This is really about the purchase of natural resources, such as those listed here. In general, what you really expect to know about the capital account is what the components are: capital transfers and non-produced, non-financial assets. Okay, over to the financial account. Foreign direct investment. This is when a firm invests in another country, usually by setting up an operation there. An example of this is bonds, buying factories in Asia to make their underwear. Portfolio investment is similar. It's investing in companies from other countries, but as shares of a company. So when foreigners buy shares in BHP, one of our mining companies, that is inward portfolio investment. If a firm or individual buys more than 10% of a company, we count this as direct investment, as this is generally a more long-term investment. A few shares could be bought one day and sold a week later, so that's considered more short-term. The last component is reserve assets. These are assets that the central bank holds of foreign currencies. This gets used as a balancing tool because, as we saw before, the current account must be balanced out by the capital and financial accounts together. If we look at the data we have here, the current account is in surplus, is in deficit, I should say, of $5 million. If we ignore reserve assets, we can see that the financial and capital accounts equal $2 million. So we need 3 million more in these accounts. So you can do the easy maths there and see that. We need 3 million more in these accounts. What the central bank therefore has to do is sell some of its foreign currencies to buy its own currency. They would buy $3 million of their own currency to count as an inflow in the financial account, this one here. The weird part is that although they lose foreign currency, their assets, it is marked as a credit. This is because it's an inflow of dollars coming in. Lastly, there is an item called errors and omissions, which is not found in any of the accounts. This accounts for the vast movement of money and the ways in which this may not be recorded. This could be just due to innocent time lags in reporting of transactions, or could be due to individuals and businesses not declaring all the transactions that they are involved in. To get the balance, which we know must be there, a number is added to ensure that the balance exists. We call that errors and omissions. When we have a current account deficit, we're actually consuming beyond the PPC. We're also spending more than we're earning. So our imports are more than exports. So yeah, we are spending more than we're earning. Therefore, we need inflows in the financial and capital accounts to pay for it. So there would be a financial account surplus. When we've got a current account surplus, this means that we consume within our PPC. We earn more than we spend. So the surplus of funds into our current account that we've got means we buy assets overseas. So we send money out through the financial account. There's a financial account surplus. This slide here sums up these ideas. I'll leave this with you and we will work on some activities in class to get our heads around all this stuff. Thanks.